Okay, everyone, so we're going to jump into capital sufficiency. And notice the word analysis. Does our client have enough money to get us where the client wants to go? So that's ultimately what we're trying to do. The client wants to retire comfortably, or they have some goal or some objective. We want to figure out, is it a realistic goal, and what's the probability that they can do that? So when you think about capital sufficiency, I don't really like that word so much. I would rather say capital needs. So when you think of capital sufficiency, I think it's more intuitive to think about capital needs. Hey, how much money do I need to put away in order to retire at 70 at this amount? So this capital sufficiency or capital needs analysis, it is used by private wealth managers, and this is the important thing. We're trying to determine the likelihood of their client being able to meet their financial objectives. Now, there's a couple ways to do this. Quite honestly, there's a right way and the wrong way. I got to tell you right now, the CFA Institute loves Monte Carlo simulation. So I just want you to think about this. Monte Carlo simulation is going to be heavily emphasized in a number of topics. And why is it so important? Because it gives us more flexibility. We're not just stuck with this deterministic or static forecast. Hey, guess what? Over 20 years, you'll average 8% rate of return. Well, Monte Carlo says, well, what if you get 2% the first year and 22 the next, and then 15 the third, and then minus 40 the fourth? So we can actually factor in so many values and variables. So I want you to think Monte Carlo simulation, it just gives us more options to incorporate things that are important for the client, and it gives us a chance to make a situation probably more realistic. So again, Monte Carlo simulation will be talked about in a lot of subjects, but one thing I want you to realize right off the bat, the CFA Institute never tells you how to calculate using Monte Carlo simulation. It doesn't teach you how to do Monte Carlo simulation. So you're not going to have to calculate or do any calculations using Monte Carlo simulation, but you are going to have to be able to interpret Monte Carlo simulation. So again, getting through the CFA Level 3 doesn't make you an expert on building Monte Carlo simulations, but it does teach you how to analyze these simulations. And then again, the CFA Institute loves Monte Carlo simulation. So deterministic forecasting, this is what a lot of people use. What's the key here? It's a linear return analysis. Hey, you're gonna earn the single compound growth rate, 6% a year after tax over the next 20 years. Is that realistic? No. Some years maybe you earn 8%, and then you earn minus 14%, etc. But at the end of the day, you average this 6%. So that's deterministic forecasting. Now, what do you need in order to use this deterministic forecasting? Well, I need to know the current value of the investment portfolio. So what are you starting with? I need to know the investment horizon. How much time do we have? I need to know the annual return assumptions. And this should also include our capital market expectations. So not just looking back using historical returns, we want to factor in our expertise and what you've been taught in the CFA material, understand those capital market expectations, and remember, the IPS with the capital market expectations combine to form your strategic asset allocation. And in the private world, especially even in institutions in the CFA world for the most likely part, remember it's typically 60% equity, 40% fixed income is a good starting point. We may move from that a little bit, but strategic asset allocation, again, is determined by the investment policy statement combined with the capital market expectations. So again, when we're looking at annual return assumptions, it is not okay to just use historical returns. You want to put some thought and analysis into this. Okay, so what are some other inputs that you need? Well, what are the cash flows into and out of the portfolio? I have money coming in, I have money coming out. I need to know these. Taxes, inflation, investment management fees. Again, you notice this is getting more complicated. And there are more variables. That's why people move from deterministic to Monte Carlo simulation. We can handle taxes and what if rates go up and inflation and fees. We can handle all of that, and it also calculates probabilities. So again, here's what I need you to know. Deterministic forecasting is easy to understand. It's also easy to implement. But what is its main disadvantage? As you go through these things, I always want you to think about what are strengths, what are weaknesses. So what is the main disadvantage? Hey, if you're using a single return assumption, guess what? It is not going to be representative of the actual market volatility. So why is that important? Well, if you tell the client, look, on average, you're going to earn 6% rate of return a year, and then next year the portfolio is down 40%, they're going to panic. You need to make sure that you understand and explain to the client, look, this is an average over a long time period. Okay, so again, deterministic forecasting, what you need to know, it's easy to understand and implement. That's a huge strength, but it also has a huge disadvantage. And that's that single return assumption. Quite frankly, it's just not representative of actual market volatility. So again, Monte Carlo simulation. I can't stress this enough. CFA loves Monte Carlo simulation. And you should too. It actually adds a nuance that really helps get your client to focus on, hey, is this probability of success good enough for you? Because if it's not, we need to go back to the drawing board. So it allows input variables, and we get probability distributions, and we can include real-world uncertainty. So all these things about taxes and inflation, recession, GDP growth, China tariffs, we can factor in all of these things. So I believe it gives us a more real-world model. Now, if we have to, we can actually use each asset class and we can come up with our own risk and return assumptions. And why is this important? Because we can determine correlations. Remember the idea of diversification. If we can put things together that are not correlated, we can actually lower the risk of the portfolio. Now, the problem is during market crises, oftentimes these correlations go up. And again, they're historical correlations. They may not be representative of the future. So you think things aren't correlated. What we find during severe market stress, many assets start to move with similar each other. So that correlation gets higher and higher and closer to 1. Okay, so Monte Carlo simulation, once we do all these assumptions, we can run a large number of independent trials. Now, these independent trials, I need you to understand they are consistent with these assumed probability distributions. So what does that mean? Hey, at simulation 1, there's going to be an outcome. Let's say it's 4%. Simulation 2, expected return is 3%, and so on and so on. So we are going to end up with a trial showing this potential outcome. There is a final output answer. Now, what's interesting, we can aggregate these outcomes, and then, again, here's the key. We can determine the probability that the client will achieve that financial goal over the investment horizon. You know, Granny Smith, there's a 70% chance that you're going to meet that goal. Is that enough? Do you feel comfortable with that? That also means there's a 30% chance that you're not going to reach these goals. Now, when we get into behavioral finance and you dive into that a little bit more and you get into the behavioral part of the exam, I want you to think about framing also. So let me give you an example. 2 years ago, I was really sick. And I went into the doctor in the middle of the summer. They're like, I think you might have caught the flu. go home and I'm cradling like a hot water bottle. I'm just freezing. Well, I go back in. It turned out I had appendicitis and I had to have emergency surgery. And the surgeon comes out there, and there's a lot of medical doctors in my family, and they're sitting there, and the surgeon comes out, and he's like, I was like, doctor, tell me, like, what's the chance of me surviving this? And he said, as long as the appendix doesn't burst, you have a 95% chance of success, of being well. But that's what I wanted to hear. What he said, you had a 5% chance of dying. So I hear dying, I'm like, oh my God, call my wife, call my attorney. I was freaking out, and my brother-in-law's like, Randy, that means there's a 95% chance that you're gonna be okay. So again, that's why this is so important, and you need to make sure that you're not, make sure the client understands 70% chance of success means 30% chance of no success. Is that too high for them? That's what Monte Carlo simulation can do that we couldn't do before. Okay, so a key consideration, unfortunately, when you're dealing with any model, you have this problem: garbage in, garbage out. So unfortunately, if your underlying assumptions are flawed, you get a terrible model. That doesn't help anybody. So when you're dealing with not just Monte Carlo simulation, but any simulation, any model, how is the quality? That is absolutely critical. Okay, so moving forward, like any complex model, the output of Monte Carlo simulation is just only as good as its input. So for me, that is a key weakness that I would know for the exam. You know what? If you get a statement that the portfolio manager isn't so sure the assumptions are realistic, well then why are you going to use that to manage your client's portfolio? Again, we need to have basically a sense of quality, and we need to feel that these underlying assumptions and these inputs, they have some theoretical background and backing. Okay, so diving into Monte Carlo simulation, what do you need to know for the exam? How do you pass this test and get your life back? Well, as I mentioned, Monte Carlo simulation is discussed in other readings. And do not forget, the CFA loves Monte Carlo simulation. So just keep that in mind, and I'd think about, why do they love it? What does it do? But it's not perfect. So I need you to know strengths and weaknesses of anything that we do in this material. So here's the thing. You don't actually know how to run Monte Carlo simulation. They never teach you that. So the questions are likely to focus on interpreting the results. You are not a Monte Carlo simulation programmer. They never show you how to do it, but you have to understand the results of these simulations. Now, wealth managers tend to use a 75% to 90% probability of success. Okay, Granny Smith, is it okay if there's a 10% chance of failing, of not having enough money for your retirement? Are you comfortable with that? If you're not, maybe we need a 95% probability of success. So again, absolutely critical. And just remember, these are probabilities. They're not predictions. We hope that this works out, but sometimes it doesn't. But the best that we can do is make sure the client is okay, and at least that they can sleep at night. If I have a 90% chance that I'm going to retire, I feel much better with that number than a 5% chance. And that's what's so important about it. Okay, now again, this is the key. If Granny Smith says, no, a 50% chance of meeting my goal is too low, I want to increase that to 95%. Then we're going to have to change the portfolio, and we're going to have to propose a different course of action. Okay, diving more into Monte Carlo simulation. What can we do? And this is always an interesting question. So if the probability of success is too low, what are some things that we can do to improve the outcomes? Well, one thing we can do, we can increase contributions over the investment horizon. Hey, Let's put in more money. That will help us reach our goal. How about this? Let's lower the goal. Hey, you're aiming too high. You wanted to be CEO? How about just getting a job at the company? Or you wanted $1 million a year. Can you live on $50,000 a year? Okay, so we can increase contributions over the horizon, or we could reduce the financial goal. That's going to improve our probability. What else can we do? We can increase the time horizon. Hey, you were going to retire at 55. How about if you retire at 65? And we have a higher probability of having that quality of retirement that you really like. Okay, and then last, how about this? If this probability is too low, if you want to earn 6 or 7% and you only want to put your money in CDs, I don't know if you've looked at CDs in the last 12 years, the rates are fairly low. In fact, they're ridiculously low. So the last thing I want you to think about, how can we increase the chances of us meeting our clients' goals? Well, we can pursue a strategy that has higher expected returns. But here's the key. So you can't just immediately put Granny's portfolio in Russian, small cap stocks. We have to, again, remain within that client's risk tolerance. And we're going to talk about this a lot in the other sections, but never forget about suitability. Just because the client wants higher expected returns, remember, their risk is ability to bear risk and willingness to bear risk. They may lack the ability to bear risk and or even the desire to handle risk tolerance. So again, Monte Carlo simulation is a wonderful tool. I understand why the CFA Institute loves it. I understand why it's used out so much in the industry, but you need to understand there are problems with it. It's a tool. Just understand the pluses and minuses. Don't worry how to calculate Monte Carlo simulation, but if it were me, I'd make sure I would look at a number of different outputs from the CFA reading and from Kaplan material to make sure that I'm comfortable analyzing Monte Carlo simulations. If I was going to bet, I would bet you're likely to see that on the exam. So again, remember, Monte Carlo simulation, just like any model, is only as good as its inputs.